Question 7 was done around about the exam average, which was interesting as it was a theory question. It was for 4 marks and it discussed the difficult topic, which was the debt ratio. So what we were told was the debt ratio of a business has increased from 40 to 70% over the past 2 years. Explain one positive effect and one negative effect of this increase. So this is a great example of needing to remember how ratios are calculated, but you actually never get marks for calculating them. So in this case, we want to remember the debt ratio or gearing ratio is your total liabilities divided by your total assets. So basically what it means is, how does the business finance the purchase of its assets? Does it use either external funds, which would be borrowing money, debt or liabilities, or does it use internal funds, in this case cash or the owner's own money? They would be equity sources of finance. So in this case, if we had a balance sheet with the following items, we had liabilities of $75,000 and assets of $250,000, we'd be left with a debt or gearing ratio of 30%. So what does that mean? This means that if there's $1 of assets, how is that $1 of assets bought or financed? So in this case, it means it was 30% of that $1 of assets was financed by borrowing money and 70% was from equity. So that means 30% of the firm's total assets have been financed with debt rather than equity. And in this case, the question said the debt ratio has gone from 40% to 70% over the last 2 years. So what does that mean? It means that for $1 of assets last year, there were 40 cents of liabilities. Now this year there's now 70. So we have more debt for every $1 of assets. And subsequently that means the equity part has actually gone down. So owner's equity would have been 60% of all assets last year. Now it's only 30%. So what we need to do is figure out some positives and some negatives, and we just need one of each. So essentially the question is, the business now has more debt. What are some positives? Well, one could be the borrowed money. We now have more debt. Maybe that was used to buy new assets, and these can be used to generate future revenue or cash. That's a benefit. In the real world, most businesses borrow money to buy new assets. So if those assets are used well, that's a positive. If the additional net profit from buying the new assets is actually higher than the cost of borrowing, we'll end up with a better ROI or net profit in the long run. So in other words, maybe we buy a piece of machinery for $100,000, but over time it generates net profits of $200,000, then that's actually going to be a benefit to the business in the long run. Using debt finance means we're actually relying on capital less, which will increase ROI. So what does that mean? It means, well, last year we had 60 cents in every $1 of owner's equity, and now it's 30. So if that number's smaller and we're making a profit, well, our actual ROI will go up based on the calculation of ROI. Again, it's good to know how ratios are calculated so you can talk about them. Let's look at some negatives. Well, the first one would be increased debt requires that debt to be serviced, which means you've got to make repayments as well as interest. So that's going to cause you liquidity problems. Secondly, the firm is now riskier. It has more debt, which does require servicing. So that might actually prevent other people from borrowing or lending to you in the future, which is an issue if you do want to buy new assets in the future. And lastly, that interest expense that comes with debt will always lower your net profit. So that's a valid negative we could talk about as well. So how did we get 4 marks for this question? So we identified 3 positives and 3 negatives. So all we needed to do was take one of those positives and explain it in full, so using a full sentence. And secondly, we needed to take one of those negatives and explain it in full, and that would have given us our 4 marks. Looking at the marks breakdown, 30% of the state wasn't able to get a mark for this question, and at the other end, 26% was able to get 4 marks. The average was 2, right in the middle, showing that most kids could maybe identify one or the other and explain it, or maybe just identify one positive, one negative, but not actually explain them very well. The examiner's comments: some students confuse the debt ratio with debtors, as in the amount of time it takes for debtors to pay us back. They're totally separate ratios measuring different things, so make sure you actually understand your terminology. And students should ensure that they can distinguish between the debt ratio and the debtor's turnover ratio and exactly what each indicator measures. So make sure you've got a formula sheet with all your formulas so you know how they're calculated and also what they mean.